Hello everyone, welcome to Module 3. We're going to be talking about inventory today. An inventory costing method is a method of approximating the flow of inventory cost in a business that is used to determine the amount of cost of goods sold and the ending inventory, merchandise inventory. The costing methods are specific identification, first in, first out, last in, last out, and weighted average. So basically there are four approaches that are acceptable according to GAAP for computing the amount of dollars to assign in the ending inventory and to cost of goods sold. And so remember, this is a method of approximating the flow of inventory cost. The specific identification method is an inventory costing method that's based on the specific cost of particular units of inventory. The specific identification method is dependent on being able to identify the specific cost associated with each individual item in the inventory. This is the most efficient way when each item in inventory is unique and has a unique identifier. So some examples would be things like automobiles. They have very unique vehicle identification numbers. Real estate, we identify by the address. Jewels, something like a very specific diamond ring, a very specific one, not necessarily a giant pile of everyday average diamonds, but a very specific diamond ring, we would be able to specifically identify that. Okay, next is first in, first out, or FIFO. And this assumes that the first units purchased are the first to be sold. So this is an inventory costing method where the first cost into inventory are the first cost out of inventory, or the first cost that we would put into cost of goods sold. So ending inventory is based on the cost of the most recent purchases because that's what's left. We took out the old ones, we have left the most recent purchases. So when we use perpetual FIFO, we account for each purchase and sale as it happens. When we sell items, we are usually able to identify which specific items we have sold, unable to identify which specific items have sold since they're all the same. So for accounting purposes, we'll assume that the units sold were the oldest units in inventory at the time of the sale. And so we will remove the oldest inventory items along with their cost from the inventory record, and we're going to leave the newest units available as part of our ending merchandise inventory. And one of the reasons that this is important is because prices tend to rise. So if you take out the oldest inventory, you probably paid less for that inventory than you did your newest inventory because prices tend to rise. So that's one of the reasons that that is important to distinguish. The next one is last in, first out, or LIFO method. So in last in, first out, this inventory costing method is one in which the last cost into inventory are the first cost out to cost of goods sold. And so what do we know about that? Since prices are rising, the last inventory items you bought are probably higher priced than those you bought a long time ago. So this method leaves the oldest cost and typically the cheapest cost, those of the beginning inventory and the earliest purchases of the period, those are left in the ending inventory. So when we sell items, we're usually unable to identify the specific item that we've sold because they all look the same, they are all the same. And so for accounting purposes, we assume that the units sold were the newest units in the inventory at the time of sale. And we are going to remove the newest units along with their cost from the inventory record, and we're going to leave the oldest units available to be assigned to the next sale. So if we know that prices are always rising, and we are either taking out the oldest inventory or the newest inventory, then what we know about that is that when you leave the oldest units in to be assigned to the next sale, as you would do in LIFO, then this is going to lower your ending inventory figure. Okay, if you did FIFO and LIFO and compared the two, your ending inventory for LIFO is going to be lower than your ending inventory for FIFO, right? So this is just a concept to kind of, get in your head and understand. And this is why people would choose one or the other. It makes a difference. The other thing we know is that if you are doing LIFO, your cost of goods sold is going to be higher than if you do FIFO, right? Because you're doing last in, first out. That means that last inventory item you purchased, the price was higher. And so when we put that into our cost of goods sold, it tends to inflate the cost of goods sold. Okay, so the LIFO and FIFO have that opposite effect on each other. And, businesses just kind of have to decide which is best for them. And of course, there are some IRS rules about what you can and cannot do and whether you can switch back and forth. But we'll get more into that as you get into the chapter. The next method and final method is the weighted average method. This is an inventory costing method that's based on the weighted average cost per unit of inventory that's calculated after each purchase. The weighted average cost per unit is determined by dividing the cost of goods sold, cost of goods available for sale by the number of units available. When the units are sold, they're removed from inventory using the weighted average cost at the time of sale. When new purchases are added, the weighted average cost per item will change again and will become the new weighted average cost that will be used for the next sale. So the weighted average method, they're not taking the beginning or the last in or the first in. They're taking everything and getting an average. Okay. So to compute the average cost per unit at any given point in time, you're going to divide the cost of goods available for sale. Now that's different than the cost of goods sold. That's the cost of goods you have available to sell. So you're going to divide the cost of goods available for sale by the number of units available. And again, each time new items are purchased, the weighted average cost per unit will have to be recomputed. However, when the units are sold and removed from the inventory at their weighted average cost per unit, the number of units may decline, but the weighted average cost of the remaining units will remain the same. Okay, so this is just a brief lecture on the different costing methods that are available to businesses. I'll post this lecture in your discussion and have a follow-up question for you to answer. I look forward to the discussion, and I'll see you there.